Today on Retiring Well with Centennial Wealth Advisory, we'll have a closer look at bonds and bond alternatives in today's low interest rate environment.
As you know, interest rates are real challenging these days. Interest rates are really low. And so I'm going to share with you what that means to different bond values and what bonds are paying you today. And we'll take a look at what else is out there that maybe you could use instead of bonds.
Coming up, we'll explain in detail one attractive bond alternative and how it compares to today's bonds.
This process averaged 4.82% a year, almost 5% a year. With how much risk to principal? That's right, none.
All this and more on Retiring Well with Centennial Wealth Advisory, starting right now.
Retiring Well with Centennial Wealth Advisory, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Centennial Wealth Advisory, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and we have got a great show lined up for you this week. We are talking about bonds and, more importantly, bond alternatives. As you know, interest rates are real challenging these days. Interest rates are really low. And so I'm going to share with you what that means to different bond values and what bonds are paying you today. And we'll take a look at what else is out there that maybe you could use instead of bonds. Now, before I do that, I want to take a minute, like I do every week, to share with you why we do this show. You see, I believe your best is yet to come. I truly believe that the second half of your life is going to be fantastic. This is a time of your life where you get to pursue activities that provide meaning in your life, that provide significance, whatever those activities are. The problem is, though, that if you're going to spend time pursuing activities that provide meaning, well, of course, you have to make good choices about your money. You got to make smart choices about your money. The second half of your life is not about sitting there worrying about what the market's doing. It's about doing what's truly important. It's about structuring your money so that it lasts. The problem with the financial media out there, the newspapers, the magazines, online, the TV and radio, they're always talking about how do you build a portfolio? How do you grow your money? How do you build a nest egg? How do you get to the point of financial independence? But what don't they talk about? They don't talk about what do you do once you've made it? Once you've won the game. You've won the financial game. You've accumulated enough money to last as long as you do, as long as you're making good choices. Now, what do those good choices look like? Right? Because guess what? The decisions you made to get you to where you're at today, they're not the same decisions you want to make to keep you where you're at today. You need to make different decisions because you're facing a different job. That's what this show's all about. We're going to talk about how to help you stay financially independent for the rest of your life, where you don't have to worry about money, nor should you have to worry about money anymore. All right, this week we're talking about bonds and bond alternatives and interest rates. So I have in my hand here, this comes from Bonds Online. This is a great little website because you can go there and you can find out what kind of interest rate bonds are paying. And so if that's what you want to invest in, you know what you're going to get. And this is pretty interesting because we're looking at this. This was all as of, I guess the information's all as of May 27, which is when I'm recording this. And if you want to go and give, and I'm going to focus on 10-year bond rates here, okay? Because that's typically what we use in the financial industry is 10-year bonds are pretty common. If you were to go to the U.S. government and say, all right, I want to buy a 10-year bond from you. And by the way, when you're buying a bond, what are you really doing? You are lending money, in this case to the government. They're paying you back interest, and at the end of 10 years, they give you back your principal. So if you engage in a 10-year loan with the government where you're loaning them money for 10 years, the U.S. government today will pay you a whopping 1.82% per year. How do you like that deal? Do you want to tie up your money for 10 years to get 1.82%, less than 2%? That doesn't sound very good to me either. Well, what about municipal bonds? Those are tax-free. I hear that's the way to go. Well, 10-year municipal bonds, what are they paying? Oh, look, depending on the credit quality, anywhere from 1.5% to 2%. 2% if you want to take some risk. So, are you going to take risk with a muni bond? Probably not. You're probably going to be closer to 1.5. Again, even if it's 2. Do you want to tie up your money for 10 years and get a lousy 2%? That makes sense? Well, what about corporate bonds? Let's go there. Maybe we can get some good deals there. Corporate bond, 10-year corporate bonds, again, depending on credit quality, anywhere from 2.47 to 2.85. You still can't break 3%, even if you start taking risk. Folks, this is why people aren't buying bonds right now. They're not paying anything. I don't want you going anywhere because in the next segment, I'm going to share an idea, something from the insurance industry that will pay you something. All right, folks, I want you to pay attention to me right now. I have a very special offer. If you are one of the first 10 people to call, and our number right here, 512-265-5000. If you're one of the first 10 people to call and you've saved at least $250,000 for your retirement, we will provide for you at no charge, no obligation, your own personalized retirement roadmap. In this roadmap, we help you take a look at where you stand currently with the risks that you're taking with your portfolio, the fees. What are you paying your advisors, both the fees you see and the fees you don't see? What about a retirement income stress test? Will your money last? We also run a tax analysis, a Social Security analysis. This is something you absolutely want. It tells you exactly where you stand with your retirement planning. It's absolutely free, no obligation, but you must be one of the first 10 people to call at 512-265-5000. Call now.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility. How to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Wednesday, September 7th or Thursday, September 8th at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
All right, in our last segment, we were talking about the problem with bonds. Bonds today are earning really low rates, as we just discovered. And the challenge with them is if you invest in these bonds in, say, a 10-year bond, if interest rates rise, you can't sell them. You're stuck with them. So what are we trying to do? We're trying to look at some bond alternatives. What we're trying to do is figure out where can we put our money where it is safe, yet gives us, at least a decent return while we're holding that position. So earlier today, in the earlier segment, we're talking about 10-year bonds. So let's look at other accounts that are 10-year accounts, and let's see if we can maybe do a little better than 1 or 2%, basically less than 3%. Let's see if we can get more like 4 or 5% returns if possible, over a 10-year period with our safe accounts. So something that you're going to want to do is look outside of the realm of what you normally look at. Whenever we look at bond alternatives, I always think in my mind what Albert Einstein said. Do you remember what he said about insanity? It's about doing the same thing over and over but expecting different results. Well, if we want a different result than maybe a 2% return for 10 years, we need to do something different. We need to look outside of those bond categories. And if you take a look at the insurance industry today, they have something out there called fixed indexed annuities that could potentially be a decent bond alternative. Now, before I get into this whole discussion, I want you to know something. There are hundreds of fixed indexed annuities out there. And I want to share this with you. There's really only maybe 2, 3, maybe 4 that are actually worth putting your money into. Most of them, they're just going to earn the same 2, 3% as bonds, not even worth putting your money into. But there are a couple that earn more like 4 or 5%. We'll get into that more in our next segment. But for now, I want you to just get a feel for how the general category of indexed annuities work. So imagine a 10-year account just like a 10-year bond. And what they do, here's how it all works. So fixed means that your principal is guaranteed. Okay, so you can't lose money. Indexed, that means that your earnings, the interest that you are paid each year, is linked to some market index. Perhaps it's the S&P 500, and I have a simple little illustration here. Annuity means that your money is at an insurance company. So let's take a look at how this general concept works. The way it works, and let's imagine, just for the sake of illustration, that this series of returns represents the S&P 500 over the next 1, 2, 3, 4, 5 years. And the way these accounts work is simply this. In years where the market is up, so if the market is up, you are going to get interest that is linked to that increase in some way, shape, or form. So for example, if they might say you get 40 or 50% of the upside. In years where the market is down, so let's use red for that. In years where the market is down, you don't lose any money, you just get no interest for that year. So if a market is down 5, down 30, down at all, you would get 0% interest in these years. However, in the years where it is up, as I said, maybe you get 40 or 50% of that. If it's up 10, you might get credited 4 or 5%, something like that. If it's up 20, maybe 8 to 10%, etc. Now, that's a general concept. How does it really work in the real world, though? Well, don't go anywhere, because coming up after the break, I'm going to show you a real world example of how something like this works as a bond alternative. All right, folks, I want you to pay attention to me right now. I have a very special offer. If you are one of the first 10 people to call, and our number right here, 512-265-5000. If you're one of the first 10 people to call and you've saved at least $250,000 for your retirement, we will provide for you at no charge, no obligation, your own personalized retirement roadmap. In this roadmap, we help you take a look at where you stand currently with the risks that you're taking with your portfolio, the fees. What are you paying your advisors, both the fees you see and the fees you don't see? What about a retirement income stress test? Will your money last? We also run a tax analysis, a Social Security analysis. This is something you absolutely want. It tells you exactly where you stand with your retirement planning. It's absolutely free, no obligation, but you must be one of the first 10 people to call at 512-265-5000. Call now.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility. How to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Wednesday, September 7th or Thursday, September 8th at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. So this week we're talking about bonds and bond alternatives. We've seen that interest rates are horrible for regular bonds, so we're looking for alternatives. And I shared with you an example of how fixed indexed annuities work, and you can potentially use them as a bond alternative. Now, I cautioned you in the last segment. I'm going to caution you again. The overwhelming majority of fixed indexed annuities, they don't pay more than 3%. They're just like a corporate bond. They're basically not worth looking at. Okay, they're just not worth it. With that being said, there are 2 or 3, maybe 4 that actually do earn a decent rate of return. And I'm going to share with you right now an example, a real world example of one, just one, that does average 4.5%, 5% a year over time, over a 10-year period. So imagine this. Imagine that you could put your money in a 10-year account, like a 10-year bond, and get 4.5%, 5% a year with complete safety of principal, absolutely no risk. Okay, if it wasn't called an annuity, what if it was called a bond? Let's say that the government had a bond where you could put your money and get 4.5%, 5% for 10 years. Would you do it? You know you'd do it. So why wouldn't you do it if it's an insurance company who's guaranteeing the money or insuring the money? I mean, goodness gracious, who cares where it's from? Let's focus on what it does. Okay, and again, not all of them do this. There's only a couple. You got to make sure you have the right one. So on the screen here, you see an example. So there's a company today. They have a deal not very different from the one we described in the last segment. They have a 10-year account, and the way it works is when they link their earnings, the interest that you earn, they link it to the S&P 500. And if the market is up, you get paid 45% of whatever the market does as interest. So if the market's up 10%, you get 4.5% interest that year. If the market's up 20, you get 9% interest. Whatever 45% of the number is, that's what you get. When the interest is paid, it is locked into your principal. If the market's down for the year, well, you just get nothing. So let's take a look at how that would have worked if you would have put money in an account like this on January 1, 2000. So you take, let's say it's $100,000, and you put it into this account, an account like this, on January 1, 2000. And the first year, look at this, the S&P 500, it's down 9%. How much interest do you get paid? Yeah, that's right, nothing. Remember, if the market's down, you get 0. Well, then the next year comes along, 2001. And oh no, now the market's down 12%. Again, how much interest do you get paid when the market's down? 0. And then the third year, it's 2002. Now the market's down 22%. How much money did you lose, or did you make? Well, again, 0. Well, I would ask you at this point, the market's down 43% over the last 3 years. and you've got 0, 0, 0. You made nothing. How do you feel about that? Well, if you're like most people, you actually sit back and say, oh my God, this is fantastic. All my friends are losing money left and right. I haven't lost a dime here. Well, from my perspective, that's true, but you also haven't made a dime, and I don't like that either. But then along comes 2003. The market's up 28%. What do you get paid? Almost 13. Now it's looking good, right? So anyway, this process follows, and you can see from 2000 to 2015, that's 16 years, this process averaged 4.82% a year, almost 5% a year. With how much risk to principal? That's right, none. Imagine that. A safe account, an account where your principal is guaranteed. It's a 10-year account earning 4.5%, 5%. That's what these do. They do give you some liquidity, 10% per year, so it's not like you're tying up your money completely. There are advantages and disadvantages. Obviously, you need to know those before you put money into them. But as a bond alternative, these can be really attractive.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
All right, folks, I want you to pay attention to me right now. I have a very special offer. If you are one of the first 10 people to call, and our number right here, 512-265-5000. If you're one of the first 10 people to call and you've saved at least $250,000 for your retirement, we will provide for you at no charge, no obligation, your own personalized retirement roadmap. In this roadmap, we help you take a look at where you stand currently with the risks that you're taking with your portfolio, the fees. What are you paying your advisors, both the fees you see and the fees you don't see? What about a retirement income stress test? Will your money last? We also run a tax analysis, a Social Security analysis. This is something you absolutely want. It tells you exactly where you stand with your retirement planning. It's absolutely free, no obligation, but you must be one of the first 10 people to call at 512-265-5000. Call now. Well, as you know, if you've been watching the show, I am now the proud owner of a Bernese Mountain Dog puppy. Her name is Banks. And she's a very smart puppy, so we thought we would go ahead and as we get questions in, we can maybe have Banks help us answer those questions. Thus, we are going to ask Banks. Anyway, before we do, I have this very, very short example of my puppy dog Banks in action. The other day it was raining, and I thought it was fun to share with you what happens when it rains at the Reese household. All right, pretty good. So Banks has learned that it's okay to drink the rain as it comes off the roof of the house, apparently. All right, so this week we are asking Banks about the Department of Labor ruling. We've gotten this question a lot in the office where if you've been watching the news, the Department of Labor's come out and they said, hey, if you deal with client IRAs as a financial advisor, well, you must be a fiduciary. Well, what does it mean to be a fiduciary? Well, according to Banks, my dog Banks, she says, Dad, it's pretty simple. Fiduciary means that you simply do what's in the client's best interests. And I thought, well, gee, Banks, isn't that what most people do? I mean, if you're in the financial industry, don't all financial advisors do what's in their client's best interests? Oh, Banks set me straight on that when she said, no, Dad, no, that's not how it works. How it works is that most financial advisors actually fall under what are called suitability guidelines. So, and that basically means that no, you don't have to really do what's in the client's best interests. Well, Department of Labor comes out. They say, all right, all you financial advisors out there, if you help clients with their retirement plans like 401ks or IRAs, you must act as a fiduciary. You must act in their best interests. Well, as you can imagine, the big Wall Street firms freaked out on that. They're like, whoa, we don't want to do that. We make a lot of money not working in our clients' best interest. We actually would rather not do that. And they had, as my parents would call it, a tizzy fit. And so what happens is they start loading all kinds of cash through the lobbyists to Washington. And so when the final ruling came out, they get to call themselves fiduciaries, but they don't necessarily have to act like fiduciaries. So I have here a great article from Investment News, because, you know, I said, Banks, how do I best describe this? And Puppy Banks said, Dad, just get that article in Investment News. Show them, tell them about that. So here it is. The title is Wirehouses Escape, here it is, the worst of the DOL fiduciary rule. And in the financial world, the word wirehouse, that basically means big Wall Street firm. And here's what it says. It says the 4 large brokerages have emerged among the least affected from the heaviest regulation to hit the financial advice market in decades. By the way, for those of us, you know, our company, Centennial Wealth Advisory, we've been true fiduciaries for years. This new ruling by the DOL actually doesn't affect us at all. Why? Because we actually do things that are in the client's best interest. But, you know, the big Wall Street firms don't, so it affects them. But anyway, here's what it says. It says, while many financial advisory firms have hunkered down about this, the big wirehouses are saying, don't worry, the sky is not about to fall. Like Bank of America said that this rule only affects less than 10% of their business. Morgan Stanley says no big deal. You know, Wells Fargo says we've got this handled. Well, why do they have it handled? Because at the end of the day, here's what all their lobbyist money did. By giving all that lobbyist money to Washington, when the final rule came out, all these companies, the Department of Labor, they said, you know, all these big firms, all that revenue sharing you do where it's really not in the client's best interests, you know, you're using your proprietary funds, that's not in the client's best interest with all the hidden fees. It's okay, just keep doing it. It's cool, you can keep doing that, but we'll let you call yourself a fiduciary anyway. I mean, folks, come on. You know that that's not what a fiduciary is. You know they're just skating, you know, as they always have. Puppy Banks says, don't be fooled. Don't let these guys take advantage of you.